So we'll go ahead and get started. Most of you know this is SRM Tech Talks, obviously, and we discuss the intersection of traditional finance and fintech. We are recording this session, and today, because of the topic we're going to be talking about, I'll just throw our standard disclosure in there. We are not offering any legal, financial, investment, or tax advice. So with that out of the way, we'll go ahead and get started. Appreciate everyone joining us, and super excited to have some guests on. They are fairly familiar with Tech Talks. I think, Josh, I had you on last about 6 months ago, and Concrete, I think we had you guys on about 10 months ago. So super excited to have the conversation again. So Josh Herman, obviously CEO of CU WealthNext, and Sean, you're the CEO of Concreit. So I'll let you guys both do a little introduction about yourselves. I think it'd be good to start just a kind of a brief background of who you are, how you got started in this. We'll dive into what your companies do here in a minute, but if you can just give a background about yourselves, a little personal information, what brought you to this, kind of the idea you had, and why you saw a need in the marketplace, and then we'll probably have a few questions. But we're going to do kind of fireside chat today. I don't know if you guys have any slides or not. You're certainly welcome to do that, but we'll just have a back and forth conversation because I'm super excited to get updates from both of you. And again, I had you on both independently, and it's nice to see you together on the same screen. So with that, Josh, you want to kick it off and tell us a little bit about who you are and your company and what you're doing, what needs you're serving in the market, how you got here.
Yeah, and I'm going to be subtle about it. I got my Concreit swag on today, Sean, representing the company. Yes, my name's Josh Herman, CEO of CU WealthNext. We've been around for about 375 days at this point, and it's been phenomenal to see where we started and where we're at now, and some of the partners that we brought to the table, like Sean from Concreit, like Hsieh from InvestFi, and then I saw Rob Goodyear's name on here as well. Rob Goodyear from AIM. So we, just to take it back a little bit, we started as a holding company. We're still a holding company. We had a wider focus when we started. So we had three main verticals. Blockchain, cryptocurrency was one vertical. Self-directed traditional investment solutions was the second vertical. And then artificial intelligence was the third vertical. And so our goal was to deploy capital into each of those categories. And as we dove into those categories, I think all of us on this call realized those individual verticals can be all-encompassing by themselves. And so you start diving into the blockchain, and Larry and there's other experts on here as well. It's not just trading cryptocurrency. Now you have blockchain platforms and you have smart contracts, and that's a whole world in amongst itself. Then you get into self-directed investing and what that actually means, and all the different asset classes that you can have, and all the different players and all the different technology partners that you can have there. And then artificial intelligence touches both of those now, and touches everything that we're doing. Anytime I log into Amazon now, here comes whoever their bot is trying to recommend that I buy something else. And sometimes they forget to add it to the cart for me. So we found that those three verticals were very, very all-encompassing. So we started to narrow our focus, and Paul Fiore joined in January of 2024. And we really narrowed our focus in the wealth tech space, and even narrowing it further down into the self-directed investment space. As we know, credit unions and community finance institutions have done a really good job of having coaching financial advisors and really good hand-holding for those who want the in-person type of financial advice. But we really saw a green space on the self-directed side of things, especially when we look at Betterment, Acorns, and Wealthfront. I might get some of the numbers wrong here, or might switch the numbers around, but I think Betterment is maybe 40 or 50 billion in assets under management. Wealthfront is 40 or 50 billion assets under management, and Acorns, typically the one that everyone's heard of, is the smallest at around 5 or 10 billion in total assets. And each of those alone would be one of the largest credit unions in the country if they were a credit union, and yet most people haven't heard of them. So we saw this huge green space to bring self-directed investing, robo-advising back to members' trusted financial institutions, which should be their credit unions. So that's kind of where we've been. A little history about myself. Started off my career actually at Merrill Lynch, right out of college, on a Barron's Top 100 financial advising team. Worked there for about a year and a half doing derivatives trading on the team. I went to annuity research and then ultimately ended up at NCUA as a credit examiner for just under a decade. Did a stop at Frankenmuth for about 4 years, Frankenmuth Credit at Frankenmuth, Michigan. Did a lot of their strategy work there, built out a cannabis banking program. Worked for Larry for a little while at SRM on the digital assets team and emerging technology, and then got the opportunity and privilege to lead CU WealthNext. And Sean, I'm going to toss it over to you, but the first time that I met Sean was actually on an SRM Tech Talk, probably about a year and a half ago, where Sean and Paul Fiore were presenting Concreit to the industry. So it's been really cool and really exciting to see this partnership come together. But Sean, maybe I'll toss it to you and give some background about yourself, maybe your story for why you started Concreit and what Concreit is.
Yeah, definitely. Thanks, Josh. So for those of you who don't know me, I am Sean Hsieh. I'm CEO and founder of Concreit. So to give everyone like the quick, I guess, background for me, I have been, I guess I'd call myself a tech guy since I was a kid. Just super enamored with technology. I started programming when I was 12. I went to school in Irvine for computer science, and that's where I met my previous two co-founders of the first company that we built. But just a little bit about like what drives me, because I think this is important as part of the story as to why I'm doing Concreit today. I grew up in a pretty entrepreneurial family. My parents came from Taiwan, and we had a restaurant growing up, and so I got to watch them work and kind of build towards their version of the American dream. And that was really around figuring out a way to find financial freedom, and their pursuit was really around building enough real estate to then be able to rent and build income off of it. That is a lesson that has kind of stuck with me. And then as I worked and built my first company and I sold it, I kind of came back to this in terms of, okay, how do I now manage my own capital? And I started investing in real estate myself. In that pursuit, I had got into a few investments that were designed for credit investors. They were, it was interesting. It felt very exclusive in my experience, and I wanted to get my family members and friends involved in some of these investments, but I couldn't because the bar was pretty high for them to be able to get in. And so that didn't really sit with me very well. And I was, as a technologist, I think sometimes we just think we can build a solution for anything. And so I got curious about, is there a way to go do this? And at the time, we were actually pretty deeply embedded in the blockchain community talking about tokenization of real estate assets. But I had also spent time talking with potential clients and customers and realizing that tokenization was really cool to us engineers, but it didn't really have a very strong connection with retail investors at the time. They didn't quite get it. And so we just told ourselves, is there a way to maybe provide, users in the future with all the benefits that we were looking for out of blending technology along with real estate investments? And that is what became the first version of Concreit. So today, Concreit is here to really make everybody a real estate investor. We believe in democratizing the asset class. We focus primarily on taking private strategies that are used in the private equity real estate markets, and then allowing non-accredited investors to be able to access those investments. So when Josh and I connected, I think it was awesome because we had a lot of things in our mission that had a strong alignment. And for me, that was something that was really important as I was thinking about, who are we working with to help people be able to access and build wealth long term.
So Josh, coming back to you, you had mentioned, and I believe you guys are a CUSO holding company. You've mentioned a couple other names, AIM and Cryptify. It seems a little like you're coming up with a number of investing solutions and kind of pulling them together. And I think even on your website, you said something along the lines of an all-in-one investment platform. Maybe talk a little bit about those components, and then maybe contrast a little to and maybe this isn't fair to throw this at you, but you mentioned Betterment and Acorn and some of those, and I did a little research into those for a different project a while ago, and I was amazed because I kind of thought all of them were very similar, right? I didn't have a lot of experience. Robinhood I kind of was aware of, and I started looking at them, and they all had a very similar look and feel in terms of their marketing and who they were targeting, but they all served very specific verticals. Some of them even like serviced, women investors. Some of them had particular types of investments they focused on. So maybe you can talk a little bit about, CU WealthNext and your approach to it in terms of that segment that you're going to sit in.
Yeah, that's a great question, and one that, Sean, we've had a lot of conversations about, and we brought all of our portfolio companies together and had the same conversation about, because Robinhood, E-Trade, if that's still a thing, that's what I cut my teeth on, and then a platform like Concrete or Betterment or Acorns. To the outside, they probably all seem really similar. They're all investment platforms, but they're not, and their core users are vastly different too. So if I want to go and do options derivative trading, I'm not going to go to Betterment and do that. I'm going to go to a platform that's designed for that. Maybe it's Robinhood, maybe it's one with better technical features. But if I want to promote financial literacy, financial education, and slowly but surely building wealth over a time horizon, then Betterment, Acorns, Concrete, some of those platforms start to come into play. So we had to stand back and go, okay, who are we aiming for with a solution, with a portfolio of companies here? Do we want the day traders day trading through their credit union accounts? And if that's the case, I mean, maybe start hooking up MGM Grand to your credit union account as well. I mean, let's just kind of all throw it out there. And obviously, we hope that your wins are more than your losses, but that's not what we're looking to create with this. And so it was really a step back. And credit unions as a whole, community financial institutions as a whole, should be in the position of obviously providing day-to-day services for their customers and members, but also being in the wealth growing business. And that's why you partner with in-branch financial advisors. And so our aim is at those slowly but surely put money aside, watch it grow, give options, robo advising. If you also want to do some targeted self-directed on your own, that's obviously an option. And Larry, I encourage you to have Hsieh back on here with InvestFi, because I think there's some really slick offerings in this space. But that's where Concrete is as well, where you can have automatic deductions coming right out of your credit account, going into their platform, and you can participate. And one of the things that when Sean and I were spending time together, I asked the same question you did, like, why did you start this? And he goes, at the end of the day, our vision and goal is that everybody can own a piece of real estate through this platform, because we're seeing, especially on the coast, that's not going to be the case, or at least in the short term, it's not the case. And so we love that vision that Concrete has. And so credit members through Concrete should be able to start building their real estate portfolio over time for as little as $5 and slowly contribute to that. And so it's a long-winded way of answering your question, but there is a vast difference in the different platforms out there, and we're really narrowed in on what we think is what the credit union members should be, which is a slowly but surely, let's help you generate wealth over time, and not be the MGM Grand of day trading.
Yeah,
Sean, I don't know if you have anything to add there.
There's gambling and investing. Those are two dramatically different options.
Yeah, I think that the tough thing is a lot of people through the last few years have associated that sort of behavior with investing, particularly with the rise of meme stocks or anything that sort of Reddit can drive a lot of volume for in terms of headlines. That's kind of where we've been, and it's been surprising because that's also been what's really fueled the growth for Robinhood itself. I think a lot of people were kind of writing off Robinhood maybe a few years back, but then I think over the last few quarters, it's been amazing to watch, how much they're actually pulling in terms of regulatory assets that they have on their platform at this point.
Yeah, agreed. Josh, something you'd said about kind of providing real estate solutions for younger people. And Sean, looking at your website, I found it interesting that you had kind of two different offerings, one on the equity side of things, one on the debt side of things, and two products, right? Home shares for equity, cash flow for debt. And I was thinking about when you said, Sean, non-accredited investors, because one of the things I was thinking about when I looked at that, I'm like, well, why wouldn't these investors, and I know the answer why, but why wouldn't these investors go with private equity or private debt? Because the returns on those are really quite large, but you've got to be an accredited investor and you have to understand the risk that you're taking, right? You might get returns in the 10 to 12% range on either one of those type of solutions, but the risk is kind of commensurate with it. And so maybe you can talk a little bit about how did you come up with the idea of both an equity and debt solution that are tied to real estate? And maybe you can talk a little bit about both of those solutions and what they look like and how they're set up. Because back in the day, I had a rental property, like a high-end rental property, and I always thought, man, maybe I just turn this into investment, sell it off as shares, but then I got to figure out how do I apportion out all the different expenses and not just the revenue. And then God, what happens if I get a lawsuit or a tax lien? And so it got very complicated very quick. So maybe you can talk about your two different solutions and how you solve the problem in this. Maybe it goes back to blockchain. Maybe that's where you got the idea around that in terms of kind of portioning out some of those expenses and revenue. But yeah, I'll let you respond to that.
Sure. Yeah. So, well, I guess, just reiterate here, this is not marketing for any of these offerings at all. But I'm more than happy to talk about the inspiration as to like how we've created some of these products. So Cashflow is our flagship product. If you go to Concrete and you've been a user on Concrete for the last few years, you've been exposed to Cashflow as an offering. We did that because in our early interviews with prospective customers at the time, we found out that the driving force for them to be interested and curious about real estate was largely passive income. And that helped us just focus in on building a strategy that could really provide that. I had personally started investing in private credit in a number of different funds, and I thought, this is so cool because I had this aha moment where I realized, hey, this really feels like passive income to me. I've had the experience of running my own rentals, and I'm like, I don't think this is passive at all because I feel like I have a part-time job. So I think for us at Concrete, we want to explore a few things. We thought, okay, if we believe that technology can help introduce new features in terms of what an offering can do, we were really curious around what could this do for liquidity. And so as anyone that's going to our website right now, you can take a look at Cashflow, you'll see that there is a consistent weekly dividend that we've been paying out for since inception. And then we also produce weekly liquidity too. And that's a very new and novel concept, I think, in the private equity real estate space, where a lot of funds generally won't have liquidity like that. So in order to do that, we needed to build our own proprietary securities accounting engine to be able to help us with fund closing. So we started building internally what looks almost like the accounting tech you may use for like a mutual fund or something like that. Because we designed this to really be working at scale to handle tens of thousands of investors in a particular offering, and then to be able to also accommodate multiple closings, and you could be at the level we're doing here. There's not really like a schedule that we needed here for it outside of what we're saying from a regulatory perspective that we're obligated to do. But the technology gives us a lot there. That's the debt side, as you mentioned, Larry. So for us, it was like, could we produce just an offering that was very focused on passive income? And then home shares was something that we got a lot of feedback from our investors that are like, hey, this is great. I'm getting passive income, but I also want to partake inside of the appreciation of real estate in the United States. And so we spent more time doing a bit more market research. There's a few directions we could have taken, which I think a lot of other platforms have done for too, which is you can go in commercial, multifamily, and start exposing that. But we actually found that for most people, when they think about the term real estate, they think about a home. And so it just made a lot of sense for us to go, okay, let's go figure out what is the asset class that most people feel like it's really out of touch for them. And I would say right now, millennials and Gen Z probably all feel like real estate is out of reach. And so we saw that within our own user base and the people that we're interviewing, the concept of being invest into a single family rental was really interesting. And so we pursued that. But we also did something different. So we could have just built a fund that then goes out and buys individual assets. But we also we were learning a few things. I think just behaviorally, our generation has been exposed to things like in crypto with NFTs and the concept of like a single asset. And so for us, the home share structure allows us to take a single home, form an LLC around that, offer the securities publicly through a qualification process with the SEC. And then what that does is it allows non-accredited investors to buy slices of an individual home so they can partake in the income, the rental income, and then also any potential appreciation. Back to your question around expenses, that's all appropriated within that particular entity. So you're not really commingled with other homes or anything like that. So as an individual user, you can come and go, hey, I really like the Tennessee market, the greater Nashville market in Tennessee, and I want to buy a rental property there. And so for us, it's like we believe that people will want to build their own diverse portfolio of real estate investments. We want to give them the ability to access it. For individual homes, the minimum is $100. So we're not talking about a lot of money, but people can start to build their own unique diversified portfolio. And that's why we designed it in that manner.
So it sounds like you're able to offer some younger people that may not have direct access to real estate today, kind of that buying the dream, but also a bit of diversification. I guess if you had to look at from a competition standpoint with the segment you're serving, who or what would be your competition? Would it be high yield savings accounts? Would it be U.S. Treasuries? Would it be something else? Because you've got a very unique offering, but from a return standpoint, who do you see as what's kind of the alternative for your segment?
We view our competitors more in a sense of looking at the traditional methods of acquiring real estate. So we would, the way that we had built the vision for the product originally was we looked at the private equity or private placement model of getting investors in and what that process looked like. And we said, can we make this better? Can we trim this down? And so we took something that was, at times 2 weeks, and we compress it down. So it's just a few minutes now. Now you can tap, you can read everything, you can swipe and sign the docs. So we feel like we really made that a very seamless process. And then in terms of other competitive platforms out there, we're in a market, it's real estate. So as you know, real estate is an insanely large market. There's no like incumbent winner, and real estate is unique because at the end of the day, it's property, and property sits within a market. And so there's also strategies that you look at, and that could be different from one house here to another house over here. So I believe that we're playing in a space that our investors, and we've interviewed a lot of our pre-existing investors, and we asked them, and they're like, they invest in a number of different platforms because they just like real estate as an asset class. So Concreit serves as a way to get access to the particular strategies that we build. Hey, Larry, I'm also seeing a few questions in the chat.
Oh yeah, definitely answer
those.
Could I
dive into some of those? Okay, awesome.
Absolutely.
So Connor, you wrote, how does Concreit's offering relate or compare to REITs? And so for those of us on this call right now, REITs stands for Real Estate Investment Trust. Generally, people, when they refer to REITs, they're referring to publicly traded REITs, and those sit within the traditional markets. So for us, we actually offer something that's considered an alternative investment, and so it's a private privately managed but publicly offered security. So you can think about the volatility or the economic ride looking a lot more like an alternative investment. We do use REIT elections in terms of the taxation structure for the underlying entities, and that's really just to benefit the investors that are going into entities. So I like to tell people, when you look at Concrete, we probably don't have the same amount of volatility as what you'd expect out of investing into something like an O or something like that in the public markets. I've written a few blog articles that go into correlation in terms of what publicly traded REITs look like to like the S&P 500 compared to what happens in the alternatives market. But if you're curious about that, I highly encourage anyone here to go dig into like what is it like to invest in alternatives. And I'm sure some of us have also participated in some private offerings as well. And then I got a question here around fractional investments and who manages the property, since they can impact the overall ROI. So 100% this has meaning in terms of the investment. We like to tell and educate our investors that when you're investing into something that's an alternative, particularly where there's illiquidity and you have to hold on to that investment for a longer period of time, you really want to focus in on the asset itself, the asset manager, the process. There's a lot of things to consider. These are all things you would probably want to consider when you're making public market investments as well. But our team that is doing the homes right now, they came from a very large institutional background. So they were early with Invitation Homes. They were also co-founders and built a company that was a nationwide property management company that they ultimately sold to Drew stock. So these two individuals we consider are strategic asset managers for home shares. They help us source, acquire, and ultimately asset manage through the life cycle of the property, even through disposition itself. And so for the current homes that we have on the market, we were able to get really good deals on the acquisition price because they have institutional fund relationships. And so we've been buying side by side with some of these larger funds. So we're kind of like getting in on a bulk discount at times. Hopefully that helps. And then, sorry, there's one last question here. So many co-owners, how are co-owner disputes handled? So generally all management decisions are handled by us. And so there shouldn't really be any disputes. They're actually LP shares that we're selling. So there's no control outside of being able to vote out the manager if something goes awry.
Let's open up, see if there are any other questions. I've got a bunch I'd still like to ask, but I don't want to hog the whole conversation. So if you have a question, just go off mute or feel free to type it in the chat.
Hey Larry, this is Jeff. I've got a question. Is there a minimum amount of time, I guess, from an investment standpoint before you can, withdraw, your shares or, however you characterize it?
For the cash flow products, there isn't really a minimum set of time. Now, if you're creating a brand new account on Concrete and you're connecting to your bank account, we do have, it's like an internal process for fraud, but it's a 60-day cool off on a bank account. And so that has probably been the longest thing I think anyone's had experience if they put money in and they want to pull money out. We just need to make sure that, the ACHs are not fraudulent. And so there's a curing period. Outside of that, if you've been a client on Concrete and you're invested primarily in the cash flow products, you can submit a redemption request at any point in time. For the home shares, that product's different. So it's an equity product that's designed to be a 5 to 7 year hold. And so we're very upfront with our investors around that. We have investors that like liquidity. Those we generally say, hey, you should probably, think about how you want to allocate and determine how much liquidity you really need. Versus investors that, let's say, are in 20s, 30s, 40s, and they're okay with an investment, like as if they were buying a rental property and holding on to it for 5 to 7 years.
Thank you.
I do have a question, Sean. How many markets or states do you serve? So where are these real estate properties located? Are they kind of one area, or are they all over the country?
We've for the homes, you mean the rental homes?
Yeah.
Yeah, so the rental homes are primarily in the Sunbelt area. We've been taking a look at states like Texas, Georgia, Tennessee, Ohio. Um, there's no geographic restriction in terms of what we're able to offer. But I will say that when you're trying to pencil out a deal in today's market, it's extremely difficult. And there's a number of factors that come into play. So I live in Seattle. I've been here for over a decade. I look at a lot of deals that I talk about even with my friends, and a lot of times the numbers just don't pencil. Like, I just don't think you can really generate income. So some of my friends are looking to buy in Seattle. They're doing it because there's hopes of appreciation, and they're just trying to figure out a way to maybe cover their mortgage for a period of time. We don't really like to provide those types of investments on our platform because, for us, real estate, we consider it as like a durable investment asset class that should be generating you cash flow. And so we generally try to find and put offerings on our platform where there's an income component, where you're not just paying for something, holding on to it, and hoping that it goes up in value. But our platform will continue to grow. We'll continue to consider and add additional offerings and strategies. So it really depends on, I think, what our client base is looking for in the long run. Larry, I think you're muted.
Thanks. Sorry about that. So as you know, the real estate market's been pretty tight in terms of inventory, and not to get political, but I'm curious how this might impact your business. Vice President Harris has been talking about $25,000 for a new homeowner, like a credit, or not sure how that would apply, but what would that do to like your properties or your investments? Does it make the market more, does it provide a market dislocation? Does it make it more competitive? I mean, I think it probably rises prices because now you've got kind of 25,000 of free money going into the system. But I'd be curious if you thought that out, and how that, there's not a guarantee that will come to fruition, but I'd be curious how that might impact your business.
Sure. We talk about that in the company, and our perspective is we don't really think it's going to have too much of a huge impact in terms of our business and what we do. So we're predominantly looking at acquiring properties for investment purposes. And so from our perspective, I do think that, if this is getting adopted, and let's just say people are coming in and rushing into the market, that we'll probably see some of that money ultimately come in and inflate the values in specific markets. But I do think the ability to even purchase a home if you're a first-time buyer is going to be largely predicated not on that $25K that you're getting in addition, but really your mortgage rate. Like, can you afford that monthly payment? And I think right now it's still really tough for a lot of families that were looking at buying homes and have just been off on the sidelines because of the current rates. We talk about this concept of a mortgage jail a lot at Concrete right now. And so it's just the whole generation of people that have, sub 3% mortgages, like, they're not really incentivized to sell that property and then shift into a new 30-year or 15-year at a much higher interest rate and nearly doubling their payment. So I think that probably is going to be a much larger impact. And I think right now it's, I feel like we've always had incentives for first-time home buyers, but I don't really see this impacting the type of product that we're going to go out and pick up.
Good response. So between just Josh, going back to you and with Sean, you can answer this question too. So what were the synergies you guys saw? I think for me it was kind of obvious, but what were the synergies that you saw? Kind of, Josh, you're looking at Concrete as part of this portfolio of companies of something that you're building, and what would this solution look like for credit unions? Because I mean, Sean, it looks like you've got a direct consumer model. So would you be competing with those credit unions? Is there a thought to go exclusively with credit unions? Maybe you can talk about that.
Yeah, so from a synergy standpoint, I think Sean, you mentioned it earlier. Philosophically, we're on the same page with who our target market is, who we're bringing into the ecosystem here. Sean's reason for starting the company, is principle-based leadership at Concrete. So from a management style, communication style, there's really good synergies and we work well together. From an offering standpoint, as we look to build out this ecosystem at CU WealthNext of self-directing solutions, self-directed investment solutions, Sean, you kind of really said it fairly well that there isn't really a direct competitor to Concrete that's out there right now. So for CU WealthNext to be able to bring this to the credit union space and offer this to credit union members, which we're going to be making an announcement very shortly about what that looks like. But it's going to be very advantageous for credit union and credit union members to participate in this platform. From a launch standpoint, John, I'll kind of toss it over to you on how you could potentially see that looking, because there are going to be a few different phases, and obviously there's an ideal situation, and then there's how we anticipate rolling this out. If you don't mind, I'll maybe toss it to you on that.
Sure. So Larry, just to kind of address your earlier question around this, we'll continue to have a direct-to-consumer distribution channel. I think it's unavoidable given we're in the app stores. I think people can easily go and search for Concrete and download, and that, for our target demographic, it's a really appealing thing. I think the synergies that Josh and I talk a lot about are ultimately an alignment of mission. And then for us, it's really been giving people access to being able to invest in real estate that haven't had it before. As you know, one of the biggest challenges for building a business a lot of times is acquiring customers or clients or getting in front of people. And I think what credit unions have right now is just decades and decades of trust. And they are many times the financial institution that's been insanely impactful in someone's life in terms of helping them, gain access to what they need in order to move forward. So we see ourselves working with credit unions in that same capacity, where if it is about investing or being able to provide real estate opportunities, we want to be able to do that with credit unions. There are a lot of really exciting and interesting concepts for us to explore as we continue to think through partnership and working together with credit unions. And I think these are the conversations that excite me, like when we get behind a whiteboard and we start talking about all the possibilities, because I think for me, as I start to understand, to dive in a bit more in the ethos of credit unions, I started realizing, like, at a point in time, they were really the innovative financial institution concept. It was like the original, P2P lending, if you will. And I'm excited because I feel like right now we're turning the corner where if we can figure out how to work closely with credit unions, there's another opportunity for us to provide new layers of value from a financial perspective, from an access perspective, that is really tough to quantify right now, but it puts us in a position where we can go and explore those things. Because I think at the end of the day, what I've seen is credit unions really, really do an amazing job winning on a relationship basis. And that's why a lot of credit union members decide to stick with them. I will say that for fintechs, that has been the opposite story. So when you take a look at a lot of maybe the banking as a service providers out there right now, they've been lacking in that regard. And so I think, as the pendulum always swings, we're going to find somewhere in the middle that we're going to land at.
Don, you mentioned the app. I was impressed with the app and your onboarding. I didn't get to go the whole way through to becoming a new client of yours, but I went far enough to see that it was very clear, frictionless. And so I just want to say you guys have done a nice job with that.
Thank you. Appreciate that. Hopefully
before-
we can get you to finish creating the
finish
account.
it up. I've got enough real estate. I don't know that I need any fractional real estate, but maybe. So for both of you, what are the next steps for the future? Are there additional products you're planning on bringing to market? Sean, you looks like you've got two strong offerings. Are there other things you're thinking about that you could share with us? Where do you guys go from here?
Yeah, so from a CU WealthNext perspective, I think we can start to pull back and kind of see where we're going to be on this. And so from a traditional fractional stock investing platform through InvestFi, through Concreit, fractional real estate, we can kind of start to paint a scenario of someone who wants to invest. Perhaps they don't have enough for a down payment on their home, but they still want a portion of their investment portfolio to be in real estate. They want fractional stock. They want control over it from a self-directed perspective, but they also want some robo advising and AI to contribute to some of that as well. So they start to build this wealth over a few years, and now say they're ready to go and do this down payment, or now they need liquidity from their investment portfolio. Typically, you run into a liquidation position event there, where now we have to contact Sean's team and say, hey, I need these funds out. Let's liquidate. Or I need to contact my broker or go through the credit union account and start liquidating out some of these investments. The full circle part of this, and I think Rob Goodyear is still on here, is with AIM, where you can now, and he was on, I'll plug Tech Talks here, go back a couple of weeks and you can see Rob's conversation with Larry about this. And AIM is another portfolio company of ours, where he's enabling credit members to now go out and borrow against these positions, these portfolios, and they're putting credit in a position of actually being able to do this in an efficient and responsible and compliant manner. And so the way that we've been describing this to credit unions is we're taking that private banking that's typically only been available and known to the top 1%, and we're bringing it out to the remaining 99%. Not that the top 1% still don't need their services, but we also think it's time to get this out to the 99. So from a next steps perspective, it's kind of tying a bow around all of those things. And there's obviously going to be additional products and features coming out of those, but we really like the story that these products can tell and start helping credit members facilitate this wealth growth process. But maybe Sean, if there's anything from your side, especially within Concreit, that's exciting that you want to change. I'll say this from an app standpoint, I've been using it for obviously several months now, and watching those dividends or those rewards grow on a daily basis. It's kind of like a stock ticker or the US debt ticker, where it's just constantly going up, which I think is a really, really cool feature. So I log in on a Friday, I get that dividend reward hitting. But I'll turn it over to you if there's any updates you want to give.
Yeah, thanks, Josh. I would say we're in a position right now where we're continuing to innovate and build new features, new products. We have the debt side in terms of private credit. We also have the equity side in terms of the home shares product as well. And we've also built financial goals, and we help our clients in terms of building more automated portfolios. And so there's a component of this that we want to continue to pursue, to figure out like what additional products and what additional strategies people we want to figure out what do people actually want to have in the portfolio that complement all their other investments, because we realize in a world where you can very easily go quickly download a new app and go set up your account within minutes and try something different, that ultimately, from my perspective, I think that the portfolio will live largely on the home screen for mobile devices. It's not going to be just within one brokerage or anything like that. So I think for us, we want to make sure that we are bringing in some of these strategies that have been very difficult to navigate for many individuals in the past. And then in terms of the work that we're doing with CU WealthNext, I think there's a lot of really cool ideas that are being discussed right now in terms of how this could unfold and how we might be able to provide deeper innovation into the things that they're looking to put together too, with all the different companies that they partner with.
I love what you guys are doing, and I love, I was just thinking, Josh, about those companies you mentioned, Sean, with your kind of equity in private debt, Rob Goodyear with his ability to borrow against assets, InvestFi with their, being able to invest directly in equities and to do things for people that might not be able to do this unless they were in a position of having a private wealth manager. And so it's kind of bringing those sets of tools and those sorts of returns to the average common day person, which, credit unions are great at serving the underserved market. You guys have identified a need that I think is underserved, and I think you guys should be commended for that. So super excited about that approach. Let's open it up to see if there's other questions for you guys, because again, really
Larry,
fast.
if I could just add one of the things that we're proud of here, and especially something that Paul Fiore has brought to the table and as all of our partners and advisors, is making this a win-win-win all throughout the chain here. So obviously, the more users that sign up for Concrete, it's better for them. They get more assets under management, and the company thrives. But the way that we're structuring it is, so right now, if a member goes out and invests in a REIT or invests in Betterment or invests in Robinhood or does something else, those assets leave your balance sheet, which they're going to, in any sort of investment scenario other than like a CD or something like that, they're going to be leaving your balance sheet. But what you're not getting out of that is any sort of revenue or any sort of fee or anything that's benefiting the credit union other than deposits leaving, which if that's the goal and you want to shrink, then mission accomplished. But most are looking to grow. And so the way that we've structured this solution is that number one, it's very modular. So if you want to go with Concrete and not the other ones, that's absolutely fine. If you want the whole package, that's obviously fine as well. But credit unions actually get a rev share from all of this activity, from the assets under management with Concrete. And so it does become another revenue stream for credit unions. And it does keep deposits not on your balance sheet, but within your ecosystem. I think that's really important when we start talking about going out to Robinhood. I recently opened up a Robinhood account against my own advice to myself. And the way that they are presenting themselves as a bank, and it kind of gets exhausting seeing all the posts and reading everything and being told how much these places are trying to look like a bank and look like a credit union. But it's really in your face that they are, to the point that it's almost easier. If I want to grow my money, it's almost easier to go to one of those platforms and just park everything there, because I'm going to get my 5.5 APY through Robinhood. I'm going to get the 3% cash back, which you can pick apart. It's not necessarily maybe the same 3% with a credit or a bank. And then I can go do my stock trading. So keeping my point is keeping those deposits within your ecosystem is very, very, very important. And getting revenue off of those transactions as well as your members participate in these activities is obviously a great bonus. And if you have a couple minutes here, I'd love to open up a question here, Larry, and get your thoughts on this. So when we pull back and start looking at the Wealthtech space, we kind of refocused on why Wealthtech. That's kind of a question that we get a lot. And I think there are a lot of us in the FI space, especially in the credit union space, that are kind of searching for this core problem right now. Because we're seeing deposits leave institutions. We're seeing a lot of negative earnings coming through, which can be economic related. But we're searching for core problems or a singular core problem, because there clearly is one, if not several. And from a credit perspective, we continue to measure ourselves from shares, which are obviously deposits, and then loans, and then all of our assets together. Whereas if you look at the big banks, they measure themselves by assets under management, which includes all these investment accounts and all of those things, which I believe is a miss when credit unions start comparing themselves to bank. But from an innovation standpoint on the credit union side of things, what we typically see is improving operational efficiency, which I think is a great thing. Reduce expenses, create more automation within the institution. But what we're typically missing is a member-centric approach. I think a lot of solutions are pitched as being member-centric, with the advantage being a cost reduction for the financial institution. So what we really saw from a wealth tech space, and once we started looking to see where deposits are going, and I know there's a lot of different vendors out there studying where deposits are going, and the reports are kind of all saying the same thing. They're going to these investment platforms. And so from an innovation standpoint, from a wealth tech standpoint, we really focused on the why, because there's, number one, a lot of green space here. There's not a whole lot of people playing in this space, keeping deposits within the ecosystem, and really giving top tier low cost solutions out to their membership. It's very, very member focused. And so it doesn't necessarily increase operational efficiency within the credit union, but it gives the members the solution that they're actually needing. And this kind of goes back full circle of just talking about where the bonus is the credit union actually gets revenue off of this, keeps deposits within their ecosystem. But Larry, I'm curious of your thoughts around that, around problem or problems within, and I hate to be the gloom and doom on this, but the problems that are potentially within the FI space. Do you see wealth tech as being one of them, and do you see it as being a need, and maybe what other potential issues are you seeing? And I hate to put you on the spot like this, but I'm curious of your thoughts.
It's perfect, because I was just thinking about something when you were talking about, investments and people like Robinhood, how they make it easy to have your money parked there. And I was thinking, this is one of the best excuses or reasons for a credit union or community bank to have faster payments, right? Because one of the problem is opportunities or problems, right? Both that you solve with money can't wait 3 days, right? So that's the reason why I park money at E-Trade, is because when the market takes a crash and I want to buy, I don't want to have to ACH money or wire money from my account to E-Trade. Or if I've got a problem that I want to solve and it takes money, I got to bail out my kid or whatever that is. I don't want to wait 3 days for that. And so I can't stress enough that I think, you guys are solving a real problem with your solution, making sure that there's connections to having money movement quick using some, instant payment type technology, whether it's FedNow, whether it's RTP, whether it's same day ACH, whatever that is. I think that's critical, and that's kind of the missing component. If you can solve that along with these solutions, I think you guys have a home run.
Yeah, totally agree. That was one of the frustrations I found with Robinhood. After I found out I didn't like the product, I had to let my money settle and wait to get it back. But yeah, happy to answer any questions about CU WealthNext or Concrete or any of our other portfolio companies.
And while we're waiting for those questions, I want to give Sean another chance to talk if he's got anything he wants to wrap with. But also, how do people get in contact with you? I mean, obviously they can reach out to me now, give them your contact information. What's the best way? And then, I presume, and I'm not offering and I'm not connecting anyone here, so understand this, but I presume that you guys are looking as a CUSO for investors and also for partners to utilize these solutions that you're bringing to market. Is that the case as well?
Yeah, Sean, I'll jump in if you want to wrap up. So from an investor standpoint, we're happy to have those discussions. I like where we're at right now, but we're definitely happy to have those discussions. If someone wants to be a part of what we're doing, our arms are more than open. There's definitely a seat at the table. Yeah, I guess I'll toss it over to you, Sean, for that. But yeah, feel free to connect with me on LinkedIn. I think Sean put his email address in there as well.
Yeah, I just threw my email in there. If anyone wants to write me an email, we can connect over email, or you can just go to concrete.com. And if you want to do live chat there, it's easy to connect with someone on our team. They'll get you in touch with me too. I think right now for us in terms of Concrete's last thoughts, we'd love to talk with any credit unions that may have particular interest in looking at adopting and trying new things out with Wealthtech. I think that over the course of the next year or so here, we're looking for additional people to come onto the list for pilots. And so be more than happy to chat about that. And that's something that Josh would be involved in as well.
Josh, to wrap, do you want to recognize any of your strategic partners from the credit union side? Because I know there's been some announcements over the last 6 months or whatever. I've been watching this space. I think maybe some of them may even be on the call today, but here's an opportunity to kind of recognize those partnerships that you have.
Yeah, absolutely. So from a board perspective, we're thrilled to have Franklin with Credit Union, Vicky Schmitzer be on our board. Zeal Credit Union, we're thrilled that they recently joined. Julie Kreinberg, and then Ron, who's the CFO over there, sits on our board. We have a great advisor team. Paul Fiore recently joined as executive vice president. He manages our partnership and distributions. We're thrilled with that. Rob Goodyear is also an advisor that we have. We're looking to make some more announcements, hopefully in the near future. But just to piggyback on what Sean said from a pilot perspective, we have received a lot of inbound interest on this. And obviously earlier pilots get better economics. That's just the kind of way fintech adoption works. So we do have a list going. But like I said, we have had some really good inbound interest on this. And so we're hopefully, I don't want to put a timeline in it, but in the near future, we're going to be having some of those pilots go live, and I'm sure you'll see announcements about those. But if you want to be a part of a future pilot, definitely feel free to reach out. Like I said, the economics are typically better for early adopters.
We'll give everyone one more chance to ask questions, so I'll pause here for that. Oh, if not, I want to thank you, the both of you. It's been fun watching your progress over the last year or so. Super excited to see where this goes, and I really appreciate you taking the time to join us on SRM Tech Talks today. It's been really enjoyable.
Thanks, Larry. Thanks, everybody.
Thanks, Larry.
Take care.
Thank you, everyone.
Bye.